As Jeanette mentioned, today's topic is a trend trader's best kept secret. We are going to be looking at a strategy that I call the Phoenix. Now, you will quickly see why I call the Phoenix. It is one of those reversal strategies that you get incredibly strong moves in the market. For those of you that don't really know me too well yet. I've been trading for over 20 years now, full-time. I started my first educational service way back in 1997 with swingtrader.net. And it really didn't, start out as intentionally an educational service. Basically, it was a blog at the time where I was sharing what I was trading, what I was looking at, and why. And it caught the attention of some of the other traders out there back at the time, and they kind of just pulled me in. So, I got into the educational part of things pretty early in my trading career as well, and I really do think that that was a strong reason that I was so successful in the markets, because from the very beginning, I couldn't just go into a trade and say, well, I think this looks like a buy, or I think this looks like a short. I needed to have a reason. And I needed to be able to understand and explain that reason. So it was incredibly important to understand the dynamics that create patterns and strategies in the market and be able to relay those concepts to you guys in a way that not only a new trader can understand, but also somebody that is more advanced as well, and really cover that range of education. So what you're going to see in today's presentation is that my style of a market analysis has some overlap with some other concepts that you probably heard, things like Elliott wave, but you're going to find very quickly that there's a lot of differences. I rely very heavily upon reading pure price action. I don't use a lot of indicators. When I do use indicators, I use them as teaching tools to provide additional confirmation, because I'm a very visual learner, and I know a lot of you guys are as well. It's much easier when you see somebody showing you how to do something sometimes than it is to read a manuscript and try to go and apply it. So what we're going to go through today is really step by step this core strategy that I use, and it is one of the top 2 to 3 trading strategies that I teach to newer traders and traders that are struggling with consistency, because it's one of those that happens in all markets and all time frames. So it doesn't matter if you're an options trader, if you're a forex trader, swing trader, day trader, scalper, it doesn't matter. It's going to work on all those time frames and in all those markets. So the basic concept of a Phoenix is we are looking to get into new trends in their infancy. So it's not really the absolute pivot low, but it is the initial main continuation that kicks off a brand new trend. So this strategy can come in many different forms. You will often see it represented within a cup with handle, where it will be the handle formation. It can take place within an inverse head and shoulders, where it becomes that right shoulder formation, and it can be just coming off of a regular old downtrend like this, pop up, we get our range, our congestion, our consolidation, and then the continuation. So basically, what we are looking to do is to take advantage of these first initial continuation moves in the market. And to do that successfully, there's a couple of things that we have to first learn and we have to go through. Basically, it's a step-by-step. Let's check off the boxes. Do we have X, Y, and Z in place? Is that going to support this particular strategy? And you'll notice very quickly by the time this session is over that the action that we've seen in the markets over the last week is the perfect market for this type of strategy to happen, even when we look at it in the reverse, which I'm going to show you an example of here a little bit later on as well. So let's dive on in here and get into what a phoenix actually looks like. So one of the first things that I look for when I am identifying this trade strategy is the trend development. Now, when it comes to trend development, a lot of traders really focus on 3 waves of trend action. I don't do that as often. I tend to focus a little bit more upon thinking in waves of 2. And the reason I do this is that because oftentimes after a second wave, momentum or the pace of trading starts to shift. So when you're looking at something like a phoenix, the first thing you want to do is identify a trend like a downtrend or a sideways trend, because your phoenix is going to be the first continuation move that kicks off a new uptrend. So it's usually the first time you will have a higher high and a higher low. Now, of course, the action that precedes that could be a trading range where you've got a lot of back and forth action, but you don't really have a higher high or a higher low yet. Or more commonly, you will see it at the end of a downtrend. So when I'm looking at these downtrends, I'm looking for things like waves of 2 of primary selling action. And then many times I like to see trends starting to shift, where momentum can start to shift. In cases like this is where you will get things like the cup with handle, or it can be a little bit more pronounced over here on the left side, and it can look like a head and shoulders pattern. And all of these are going to lead to the development of this initial continuation move on the upside. So with trends development, basically we are looking for trend exhaustion going into levels of support, and then a change where we start to initially see that trend start to shift. And to do that, we are now going to be looking at the second building block. So our trends development is the first building block that we need to check off. The next one that we need to check off is going to be the momentum. So momentum is the rate of change of buying or selling in the market. So when we're looking at momentum, I like to look at periods where you will see these V's and inverse V's taking place, and this represents pretty typical standard momentum within a range. And within that, after you start to see that begin to change, you will notice that shift in momentum starts to be one of the very first things that you will see as the trend begins to reverse. Now, oftentimes, the initial start of that move can be a stronger wave of reaction off of the lows than compared to some of these previous sell-off moves. Other times, you're going to notice that the channel, after it hits a high, sometimes it's the previous high, sometimes it's the zone of this previous high, sometimes it's a slightly higher high. But as it hits that high, the momentum of the trend starts to change. Now, really quickly, when you look at this is a 200 tick chart that we're looking at. When you look at this on the smaller time frame, you'll notice that moves off of this high here initially are still pretty strong. We still have that inverse V happening. This isn't always the case, but it's pretty normal. So if you're just looking at these smaller moves, you might think, well, you know what? The downtrend action, the downtrend momentum is still incredibly strong. But when we look at the channel itself and we look at the highs and the lows that are now starting to form and transect that channel, then we start to see momentum begin to change. And now we have a much more gradual sideways type of correction here, where we have the slower pace compared to the upside pace. And this is one of the very, very key components that we need at the very beginning of this pattern development. Now, another thing when it goes to trends development here, I mentioned that I like to look and think in terms of waves of 2. So a lot of times your corrections off of resistance following this move off of low will come in waves of 2. So you will start to get initial moves that can trigger a phoenix coming off of that second pullback, that second correction there. And we can then look for continuation moves. So let's go on here and look at our next slide, and we're going to look at another thing that is a key feature for this pattern, and that is time development. So this is a very often overlooked feature where you will see that if we look at things as how they happened in the past, you will see that periods of correction and periods of congestion that happened in the past will often repeat themselves. So you'll notice that if you had a strong move off of a high, like a move that you see coming off of the lows, where the impulse moves are very comparable and lead to this period of congestion, then you can get these continuation moves after that same period of time has passed. So let me reword that. When you're looking for a phoenix, one of the first things you'll notice is that strong impulse move off of the lows. Oftentimes this is stronger than some of the previous sell-offs. Usually it might be about the same as some of the previous sell-offs if you've got some of these V formations forming. But you want to go back in time and look for other impulse moves that are of similar distance, similar momentum, similar distance. And then look at how long they took to correct before you would get another continuation move that would also have a similar type of impulse move. So when this develops that same amount of time, that is what tells me that this is primed for an entry trigger. I have less of a chance of getting into this too early and more of a chance of being really on par with my timing and getting into it at the exact right location. Not too early, not too late. If this spaces out too far, then my setup might be a lot higher risk because at that point, it basically took too long to get going. And it could be more prone to failure at that point. So we want to watch that time development as well as the trend development and the momentum. So these are things where you're going to start to see divergences from a lot of the strategies that you've been taught in the past. You've been taught, look at counting waves, look at things like RSI or CCI or MACD, all of these other indicators to help you recognize this. But you can get that same type of analysis without overloading your charts with a ton of indicators just by learning how to read pure price action. So this time development here is just another one of those factors that we need to have within the development of the Phoenix. Now when we look at entering and putting our stops and our target levels, we look at the individual parts of this Phoenix development. So if you have this period of congestion where our momentum is now shifting and you can see different swings of action back and forth within that channel, then you have the chance of getting into a strategy where you might have your stop end up only being 1/10 of what you end up making on the position, and sometimes a lot more. Because by looking at these smaller swings, we can go ahead and take entries based upon channel breaks within that smaller swings. You can even get phoenixes happening within the larger phoenix itself. So when I'm looking to enter these, this is my favorite way to enter this. And I'm going to show you kind of other ways to do this as well. So we've got 3 ways that you can enter this strategy. The first one is as the channel from the second wave off highs breaks. So that means when we've got our impulse move off of the lows, we've got an initial high and an initial pullback, wave 1 of correction. Then you get wave 2 of a correction. Well, when that wave 2 channel breaks higher, that offers the trigger. So this is really easy to do if you're seeing a Phoenix developing on like a 60-minute time frame. You can then drop down and use like a 15-minute or a 5-minute and look at the waves on that and watch for these shifts in momentum. Now, a secondary entry, when you have momentum that might be still pretty strong like this, where you've got the V's and the inverse V's, a lot of times if you get measured moves for waves 1 and waves 2, that can lead to that Phoenix within the Phoenix, meaning it can be part of like a cup with handle that creates this period of congestion, or it can be part of an inverse head and shoulders like I've drawn in here. So when that happens, you can actually tighten things up even further, meaning you can take an entry based upon that channel break of that smaller Phoenix. And a lot of times that smaller Phoenix has 2 waves within it as well. So you can really, really narrow down where you are getting into these. Now, the third entry is the one that I like to take the least often, but sometimes there's not much choice to do so. And that is to connect these highs and basically take the break in that last portion of the channel. Now, I will do this more often if there's a lot more overlap, like from one bar to the next, and I can't see these swings back and forth as easily, or if when I do drop down to the smaller time frame, those swings are really sloppy and it's harder to really identify strong, smaller time frame setups, that's when I will use that channel break. The problem with using that channel break, though, is that when you are looking at stop placement, if we go and look at stop placement on the larger type of strategy where we have this channel break, then you'll notice your entry is as the channel breaks, but your stop has to be under that entire low of the channel. So this can mean that compared to what you're risking, your target levels might be a lot closer. So you might only get 1-to-1, 2-to-1, 3-to-1 compared to what you're risking. Whereas if you can nail it down to some of these smaller swings within the channel, you can get substantially more. So here's a trade from yesterday. We had take place in Apple on the 5-minute time frame. Really, really core strategy. So with this, we had the reversal off of the lows, a little bit of a sort of W-ish, cup-ish formation. And again, I don't get too wrapped up in thinking of cup with handle, head and shoulders, inverse head and shoulders, because what I'm looking for is this momentum change. I'm looking for a strong upside move off of the lows and then a shift in that momentum, where I then have a much more gradual channel on the pullback. And sometimes that means the initial downside within that channel is still really, really strong, but overall the channel itself is starting to shift. So here you can see that on Apple, we had 2 swings to the downside, but things are a little bit sloppier inside. This one has a little bit of a W in here. This one kind of pauses here with the momentum, pulls back down. So it's a lot trickier at times to get into that at that level without missing it or without risking getting into a trade that just really isn't as strong. When you had that shift in momentum at the upper end of the channel, like here though, where you've got a Phoenix within a Phoenix, it's a much stronger setup. So in situations like this is where I will take that entire channel break as an entry. Otherwise, I'm not doing that because I don't want the risk that I'm just getting into a false break in the channel right here, and then momentum changes, and then it breaks lower. So that's what I'm looking for the entry. And you can see here I've already got a target marked on this one. And a target on the Phoenix is really straightforward. And the reason this strategy is so great to work with newer traders or traders really trying to build consistency is because things like entry and stops and targets are really straightforward. So when you're looking for a target on the Phoenix, I am watching this momentum of the impulse move going into the correction, and as long as the momentum coming out of that correction is similar to the momentum over here, so as long as B is similar to A, I'm looking for that 100% equal measured move. And I'm going from the last low within the Phoenix to give me that measured move because I'm looking at the impulse move coming out of the Phoenix. So sometimes you'll have a lower low here in the middle. That's not the low I'm using. I'm using this last low to look for a target. And you'll notice that when this hit that measured move, it stalled it immediately. Like there was an immediate reaction there. Even when the market is gaining strength, and sometimes it might be a little bit stronger than that impulse move, that 100% level is often a level where even if it tries to push higher, it changes the momentum of the trend. So then you can get a series of slightly higher highs, but the best portion of that move is already established. I'm going to show you guys more examples of this here in a little bit. With all of my presentations, I take trades that I've done over time. So I like you guys to realize that the techniques that I'm teaching you here aren't ones that are just working in today's market. They're ones that worked last week. They're ones that worked a month ago. They are ones that worked 5 years ago, and they are ones that worked 20 years ago. So this exact same strategy in reverse is one that I used to time the market pivot in the NASDAQ back in 2000. It's the same one that times the pivot in the Bitcoin not too long ago, where we had that market high. You're just flipping the Phoenix on its head. And so it is one that repeats over and over and over again. Now let's go into some variations of this here. So I'm going to show you guys this, going back to this example of here's the euro dollar. So we were looking at this a little bit earlier. Now when you can get into a trade on a smaller time frame, the advantages are obviously that you can keep your stops tighter. Now if I'm taking this first channel break here, I'm keeping that stop under that second low. So first low, second low. On the other hand, if I get into it on a smaller Phoenix within the larger Phoenix, I'm keeping my stop under the low of that second Phoenix. Now this might seem like a little thing, but it is something that can dramatically increase your return compared to what you're risking. It can be the difference between taking 100 or 200 shares of a stock. So you can get oftentimes twice what you might have been risking if you had put your stop under this entire low here. What's the difference though? The difference in terms of whether this stop hits and this stop hits is very, very slim. So you are increasing your reward potential, but not really increasing your risk very much by moving it up to use that tighter stop. So again, a big advantage for using some of the smaller time frames when you can, as long as you have that Phoenix that's taking place within the larger Phoenix. Now we go and look at this one and look at the target level on this. And you're going to notice very quickly, this goes way past that 100% initial target level. Why does it do that? Oftentimes, it has to do with what's happening on the larger time frames. I don't like to look at strategies in a void where I'm just like looking at one snapshot, one time frame. It's always important to look at multiple time frames. When you look and see a strategy that is forming one day and it works out perfectly, and the next day it falls short, and 3 days later it extremely exceeds your expectations, what's the main difference? It's almost always the larger time frame. So when you're looking at the larger time frame, that can help you get to some of these larger target levels. So if you are just going into this, for example, as a day trade, typical target level with this would be the 100% extension. And I usually have an exit on the books as it's going into that resistance level. But with a Phoenix, because so often a Phoenix is a trigger for a reversal on a larger time frame, you can usually find that that Phoenix might be taking place at a level in the market where you have it triggering a much larger reversal strategy or a much larger breakout strategy. In this case, here's those two waves off lows or highs that shifted momentum, and here's that Phoenix. Well, where's this Phoenix taking place in the larger trend? It's midway, where we've got this larger impulse move back in here. Here we had a trading range, an early attempt at a breakout, and then a second pullback. Now, a lot of traders, again, will get wrapped up into thinking an Elliott wave on this. They'll think 1, 2, 3. You know how I'm thinking of this? I'm thinking of this as wave 1 up, first wave of a correction, second wave of a correction, breakout. What's the difference? The difference is that when I go and look at targets, instead of trying to look at measured moves compared to this move here, I'm looking at the measured move back in here. Because if this attempt to continue the trend is shorter than the initial impulse move, there's a much better chance that this is really just a tilted thing, like a tilted phoenix or a tilted flag, and this is really your true continuation of this impulse move over here. So you're going to see this repeated over and over again, where sometimes you might see a phoenix here, you take an entry, you might be looking at, okay, here's the initial 100% measured move target level, but you might say, okay, you know what, it had a much larger move there, so maybe it'll pause and continue, and then it doesn't. You don't get that continuation. Do you just bail on the position? What do you do? There's the tricky question, right? Well, if previous periods of time development show you that this impulse move is often followed by periods of correction lasting this long, then if I get a trigger in here, then I'm usually going into it thinking, okay, this may be a really strong setup in here, but if I'm going to hold this long term, I might be risking a pullback into the trading range. So I don't move my stops too fast on some of these because I want to have that ability for some of these two-way corrections back into congestion. Obviously, that doesn't always happen. That didn't happen on Apple yesterday. And as long as the time development works out, it's less likely that that's going to happen. But when you go and then look at, okay, target levels, well, you might have had a measured move target level intraday that hits right here, but the larger target could be based upon an impulse move that's taking place on a larger time frame. Now, I'm going to go through a couple of the next slides just a little bit more quickly. So I told you earlier, I use trades that I've taken over time. So I gave this presentation to a group a couple of weeks ago, and this was what was happening in the market that day and the day before. So we're looking at trades from back then, but I want to get into some of the trades that are happening this week and over the last week as well. So I'm going to show you guys another example that happened back then that shows you a variation of what can happen. And then we're going to get into some of the stuff that is more recent. So here's a trade on Apple. And a couple of weeks ago, Apple was trying to break out of this channel. In fact, you can see this little phoenix up here on the daily time frame breaking it out of this bigger one. Now, what we had happening was there was a gap up out of that trading range. And within that, when I get this type of breakaway gap, I'm dropping down to things like the 100-tick chart for a stock, and I'm looking for ways of action that can offer me a setup in the direction of that breakaway gap. Oftentimes, that means a phoenix. So I'm looking for things like two major waves of correction. In this case, they each have a couple smaller waves. And then I'm looking for those stronger pivots off the lows. So this is a really core type of action that I look for. You will notice that if you go back and look at Facebook when it IPO'd, it had this exact same series of price development. It had the two waves down, it had the move up, it had the phoenix. This is a 100-tick chart in Apple that happened, let's see, on the 12th last month. And it's the same thing that happened on the daily time frame of Facebook several years ago. So you really do have core price action that repeats itself over and over and over again. And once you learn how to read price movement from one pattern into the next, then you're going to see these popping up over and over and over and over again. Now, with this phoenix, you'll notice a couple of things. Time development wise, this period of congestion, pretty similar to what we had back in here. So I was perfectly okay looking at that as an entry trigger. Had an initial momentum move on the downside here, a pop, a little two-wave correction where the momentum shifted. That's awesome because that can often lead to some of those stronger moves on the upside. Now, what we're going to see here as we move forward though, is that it doesn't follow through as quickly as you might have expected. It wasn't like what we saw in Apple yesterday. It didn't get going immediately. In fact, it popped up and fell right back into another trading range. Now, when this happens, I'm not as concerned about it because if the larger time frame is still favoring upside, I might consider that this could just take a little bit longer to get going. Now, what did have me a little bit concerned there was that the market itself was pretty overextended at that point. So I wasn't too excited to be buying things. So I really went into a lot of things, looking at them, focusing on the intraday action, focusing upon things like these smaller phoenixes, and then looking to the larger time frames to see if I could get a little bit more out of it. Now, this is important because when it comes to trade management and managing this position as it unfolds, you have to look at where are you going to adjust the stops. Now, one of the additional things that I didn't talk about earlier on Forex, because many people don't have volume on Forex, is volume itself. Now, volume is another indicator that you can use to give you a visualization on what the price action is doing. So within the development of a Phoenix, it's ideal that you see volume decline or at least go flat. You don't want to see it increasing as you are getting this pullback and this correction. You want to see it dropping off or going flat. And that's what we saw happening on Apple yesterday. It went flat. Now, when this offered the continuation here, and we look at the target levels on this, my initial target level was that 100% level. What you'll notice here is that it struggles. It struggles. It hits the 50% extension. It hits the 61.8% extension. It hits the 76.4% extension. And at each of these levels, it's pausing. What you notice, though, is that when it pulls back, each of the corrections is still more gradual than the upside move. So as this is moving higher, I'm adjusting my stops to under each low when it hits a new high. And what I'm watching is that momentum. If we had seen a momentum shift, for example, where it popped up here and then pulled back really strongly like that, and then started to base out, well, then I'm going to be using the channel break from that base as a trailing stop, because at that point, it would be more likely to break down and have a really sharp counter move to it. So watching momentum is really, really important. So as this approached that 100% level and moved past that 76.4% level, this is again a Fibonacci extension, then you can see that the momentum begins to shift. So if I was just day trading this, just looking to look at kind of these first impulse moves on the continuation, this is where I'd be getting out of that position. Now, in this case, I was going with a larger time frame, so it offered a little bit of a larger target level. But this is how you look at this and think of this in terms of what's happening on the smaller time frames and how to adjust those stops that can keep you into them, but be careful if momentum starts to shift. So as this continued, we'll go forward a little bit more quickly here. You can see that here is the extension where I mentioned earlier that when I'm looking at measured moves, I'm using that last low. So originally going into it, I'm using that 100% level based upon the move on the two-way correction. But when this breaks that channel, it's showing me that it's finally breaking out of that trading range. So now at that point, I'm looking at that 100% based upon the last level there. So it gives me a target level that is even higher than what I was originally looking at. Now, if we go forward even further, what you're going to notice here is that this is what was happening on the larger time frame. On the larger time frame, it had broken out from a Phoenix the previous day. It even had a little smaller Phoenix intraday on the 15-minute chart. And it was hitting that 50% level compared to the impulse move that went into this larger period of correction. What that meant to me is that when I paid attention to what was happening on that larger time frame, I recognized that, yes, I had these resistance levels that were going to be hitting intraday. But if I kept that larger time frame target in mind, I had a good chance of getting much more out of the trade because the momentum of the gap basically gave me that same momentum type of move that I had going into this period of congestion in the first place. You'll notice that momentum does start to shift here as it goes and comes into that 100% level. So it doesn't hit it perfectly before you start to see some of these stronger pullback actions, but it comes really, really, really close. Now, if we look at, let's clear this here. If we look at this based upon that extended target level with that last pivot low, there you can see that 100%. Now, I want to show you guys a trade from last Wednesday. So I taught a class again last Wednesday, and I used a trade that was happening live where I grabbed the charts as it was unfolding to show you guys as I was exiting this position. So when I'm looking at, the early stages of these patterns, that trend development is the most important thing. So early on, you can see that there's a little bit of a weak downtrend taking place. The momentum increases on the downside, and then it starts to shift again, and then it bounces strongly. So with this bounce, this is where I'll start to look for continuation moves, where if I miss, this move off of the low, the next pattern that usually happens is going to be the Phoenix. Sometimes it happens right here, where it's basically that last move down took place. Sometimes it happens at this previous high, and sometimes it happens, slightly higher here. But always in this zone, you will usually see a pause and a continuation. It's the perfect location for a Phoenix to happen. So here's the really beginning level of where this trade started to develop, where it first came into resistance back in here and momentum was now shifting. Now, the next thing that I noticed was that we started to have a slower channel on the correction. So now we not only had the stronger impulse move on the upside, but I also had this more gradual pullback and correction here happening. Another thing you'll notice that I posted on here is the 76.4% fan. Now, I said earlier that I don't use a lot of indicators. Well, Fibonacci is one of the exceptions that I use, especially when helping traders with recognizing time development. So things like the Fibonacci extension will help you with looking at just adding measured moves. So you can visualize that, just eyeball it as well, but a Fibonacci extension will give you a more precise reading. And you can use fans to help you determine, has this corrected long enough to offer you that pullback? Now, when you're looking at something like how to draw these things, you can be looking at things like, let me just pull up a chart here in today. So, for example, if I'm going to draw a fan on here, this is going to be on TradeStation. I'm going to usually go from that low to that high. And then what I want to look at are periods of where it comes into some of these shorter term fans. So when it's coming into like the 23.6, the 38.2, the 50%, is it pausing at those levels? If so, then that tells me that, the 76.4 or 68.3, those are all going to hold really, really well also. So, just looking at this, you can see that these fans hold pretty good here based upon where I drew it from this low to the high. So as this comes and retests these levels here, those are also levels that are probably going to get me a decent reaction. And oftentimes with a Phoenix, if you draw it from the low to the high, your Phoenix can base out to that 76.4% fan. So if I go back to the PowerPoint, then that's basically what you're seeing there, is you're seeing me draw out that fan to help give a little bit of a better visualization for how long of time development we might see. Now, at this point, we've got it coming into that fan. We've got two main legs down with a little bit of congestion here in the middle, a little bit of bounce, and then an even smaller Phoenix is starting to form here. So basically you've got this inverse head and shoulders now forming within this larger Phoenix on the 30-minute time frame. So another thing you'll notice here is that I added a time extension. So time extension here helps because When you're looking at things like an inverse head and shoulders, if you've got a right shoulder that is 100% time extension between the left shoulder and the head, then that's also a really great spot to get that Phoenix triggering. So what are things to look for time development? Well, you can use measured moves like measured periods of correction in the past. You can look at things like the time development here, like with an inverse head and shoulders. And you can look at things like the Fibonacci fan. All of those will help you with that time development. Now, as this progresses, here's the trigger. Basically, it's that smaller Phoenix, which has even little smaller head and shoulders happening right in here, and that's the trigger for the channel. So in this case, your channel breaks are pretty much the same. You've got, it's breaking that larger channel and it's breaking the smaller channel, and that is ideal. So when I'm looking at a stop placement, my stop is really close. It's just under that smaller channel. It's not under this entire low, because when I look at the time development is really good. There's a good chance that it's going to go at this point, and I'm less likely to be too early to get into the position. So I'm perfectly okay using that tighter stop. Now, with this, as it continues, here's the stop placement for the original move. And like I said, like I drew here earlier, you can actually even tighten this up even further. This is a 15-minute chart, so you can see there's even a little Phoenix here on the smaller time frame. It would have been the 5-minute time frame. You can use that stop as well. Now, here's the target level on this. And what you'll notice is that just like the Apple gap, it started out quickly, bam, and then it paused. So initially I'm going into this thinking, okay, measured move, my target level, as long as momentum remains steady, is going to be right there. But you'll notice that it stopped right at that 38.2% extension. Now when you're drawing the extensions, again, I use that last pivot low within the range. So that tells me that, okay, yep, this is a first initial level of resistance. And what often happens is, like you saw on the euro dollar in the first chart, sometimes you might be getting into this where this ends up being wave 1, and then you end up getting a second wave and then the real continuation. So as long as momentum is working and holding in your favor, don't get too worried about some of these initial corrections. This is where I don't move the stop too quickly, because a lot of times these corrections can take 2 waves. So they can come back into that break-even zone. And this is where people start to mess up, because if they have their stop this tight, they see it go up to the 38.2%. Wow, you've got like 3 times what you were risking already there in terms of return. And they don't want to take a loss on that. So you have to really go into these thinking, okay, are you really looking at the larger picture or the smaller picture? Which one are you going to go with? Smaller picture, yeah, that's a good place that you can see resistance start to hold. But if you've got a larger time frame strategy, why are you going to get out at that point? You really have to be prepared to hold for some of those 2-wave corrections that might bring it back into this range. So I don't usually adjust my stop for the initial one until I've had 2 waves of correction, and then it's breaking to a new high. And then at that point, I will move it to under that next low and adjust it higher going forward. So as this progressed, you can see it basically mirrored what we saw on the euro dollar earlier. Here's the original breakout, here's the continuation, and here's the target level if you used it based upon the original target level. Now, because of this being a 2-wave, usually I will then move the extension to under that low there, to that low there, to look at for target level. But I want to show you guys what happened here. So on this one, you can see that when I move that extension, it's coming up here. You can see I took the screenshot right as it was hitting that level, and this is where I got out of this trade. So the reason I got out of this trade was not only because it was that 100% extension on this level when it started here, the 76.4% extension here, but it goes to something even bigger, and that's that larger time frame. So when we see this happening, usually that target's going to be at 100%, right? Because it's a two wave now. So I'm going with the last low. So I'm looking for the 100% extension. Well, what's happening here? Momentum is shifting. There's a slower overall channel than there was back here. And even though we are getting strong upside move on the micro levels, that channel itself is slowing down. And this becomes even more noticeable when we go and move to the larger time frame and look at what's happening there. So on the larger time frame, as it's coming into that 76.4% resistance based upon this move and the 100% resistance based upon that move, you'll notice it's right at all of this previous resistance where the upside overall is pretty similar to the downside overall. So that's a major zone and it becomes really difficult to move past that level. So I figured, best case scenario, maybe it pulls back, retest that level. It could pull up a little bit later, but I didn't want to hold through a lot of those corrections. So I just had an order on the books as it's going into the resistance, take me out of it. And this is what you can see as the pullback. So had the three waves coming out of it. Here's the pullback. This is often where you could sometimes see reactions where in cases it does go and shift momentum to get to those upper levels, it will do it at that point. So you've got to decide, are you wanting to hold through some of these corrections just to get some of those larger target levels? If there's a lot of resistance, I'm not going to do it. If there's less resistance or the resistance is a little further overhead, then yeah, I'll probably hold some of the position. Usually not all, but some of the position to try to get a little bit more out of the rest of it. Now, let's show you guys some action today. So we've seen this here happening in the past over the last, month or so. We saw a couple trades from a trade from yesterday, a trade from last week, a trade from a couple of weeks ago. Well, here's one that happened today. So here we have the dollar krona. You can see I've been doing a lot of forex trading lately, but I don't just trade forex. I trade all markets. So futures, forex, basically you name it, I trade it. So the market right now is really excellent for these Phoenix strategies because we've had really strong downside action over the last week or so. And so in many of these markets, we are seeing these shifts in momentum at the lows. We're starting to see these strong movements off of the lows, and we're starting to see some of these more gradual pullbacks and more gradual corrections. So this is the perfect trend development for some of these smaller time frame Phoenix strategies. Now, obviously, when we look at the larger time frame, the overall market is much more extended on the upside. So even though we've got like that strong drop where we had a really good downside move for about a week, the chances of these Phoenixes offering like really, really magnificent upside continuations is going to be less. A lot of times they're going to be some of the smaller moves where we get more of those equal moves and then you can see a pause. So this dollar krona, this is where it was hitting resistance right as we were going into today's session. I can pull that up, see what it's doing right now. See if it held that level. You can see that, let's see, what time frame are we looking on? You can see it's going a little bit past that now, but kind of the same zone. But when I'm looking at these type of trades, I'm looking again and paying attention to some of these previous levels of resistance. So if I've got that measured move level with that resistance level, I'm going to be taking off part of the position at that level. Now here you can see that it's still in the zone from that previous level of resistance, and it's basically hit that measured move on the smaller scale. So the next level would be that measured move on the larger scale, but you'll notice that this took a couple swings to get there. So usually if it offers that continuation, it'll take a couple of swings to get there too. But this upside move compared to this downside move, you can see that took a long time to correct before we got it turning back around again. So this is a pretty short little phoenix compared to some of these previous periods of correction, previous periods of congestion. So that does open the door that can go like that, where you can get these kind of shifted phoenixes on larger time frames. Getting into some a little bit more advanced stuff there for you guys, but I want you to realize that when you're looking at these, there's a lot of ways that you can apply them so that everything doesn't always have to be picture perfect. It doesn't have to look like your standard textbook strategy. Once you understand the basic concepts of the strategy, you're going to start to be able to apply it to even scenarios where things might be a little bit different, but the spirit of that strategy is still there. Now, another trade here, looking at a GM today. So GM yesterday offered another phoenix with a continuation into today. Now, when you look at how do you take this trade on here, we're going to be looking at things, first of all, the trend development, what's happening on the larger trend on daily on GM. Well, it was in a trading channel. So it was coming into the lower end of that trading channel. Granted, momentum was pretty strong. That was actually a con on it because a lot of times third test of a channel can lead to a break of it, but it was still a major support level. So then it depends on what's happening on the smaller time frames. Are you starting to see momentum kind of shifting on the smaller time frames? Well, on the smaller time frames, we had a channel like this. And yeah, it had a little bit of a push towards the end of it, but our lows are all pretty evenly spaced, which is actually another strategy that we're not going to get into today, but it's called a momentum reversal. And so when this turned around yesterday, it had a really sharp move, counter move, back up into that channel there, really, really fast. And then at that point, you can see the momentum really starting to shift. So we had an initial little two-wave pullback. So that's that typical kind of two-wave measured move you can get. Popped up, another little two-wave move. So you actually have a smaller phoenix within the larger phoenix again. And that is definitely what I love to see more than anything else, because it allows me for those tighter stops. I don't have to keep a stop under the low of the entire channel. I can keep it under the low of that last little phoenix level. So this offered that trigger for the breakout. You'll notice it didn't hit that measured move right away. It hit the 61.8. So sometimes that means it might pause and go a little bit longer, do a two-wave like that before it goes up to hit some of those larger target levels. It's something that when I'm going into the Phoenix, I'm keeping that in mind for when I'm managing the trade. So if it hits something like 61.8, I'm not usually too concerned. If there's a good level of resistance, then it might be something where I'm going to take off some of the position, but I'm usually going to hold for that large target as long as the momentum is really strong, because there is a good probability that I'm going to get another continuation move. Sometimes it's faster like here, sometimes it takes a little bit longer like we saw in some of those other trades. Now in this case, the momentum is incredibly strong on this continuation. You'll notice that when you look at that first extension, it leads to 100% level right up here. But if we look at, where that move continued again here, it's a little bit closer to what we saw over here. So again, you can apply these measured moves. Fibonacci is always a good tool to use to give you a little bit of an additional visual advantage, because even when you get the extensions, you can see it pause right at that 100%, pulled back, so you got that tail on that bar, then a little bit of a slowdown when it went into the 123.6 and finally held that level right there. Again, because this momentum's so strong, it even has the possibility that it could retest it a little bit later on. But this is the most secure, best, easiest way to get an exit. Now, I mentioned earlier that, this strategy is really key to what's happening in the market right now. And one way you can see that very, very keenly and is just looking at what happened in the overall market. The opposite strategy of the Phoenix is the avalanche. You take everything that you learned about the Phoenix and flip it over, and there you have your avalanche. So what was the key strategy that triggered this reversal in the market here this last week? Well, in my forward focus group, we were looking for increases in selling. We were looking for sharp momentum reversals. And this strategy is one of the very first that you look for those reversals. So here's your move on the downside. Here's that two-wave correction, initial trigger, when that second wave breaks. And then in this case, it had that continuation with a little bit of a sort of a head and shoulders, not quite, but you can see that smaller avalanche right here within the larger avalanche. So that's actually what kicked off this entire sell-off in the market. And a lot of traders get too wrapped up in news. You know, like Hubert mentioned, he doesn't really pay too much attention to the news. Neither do I, because this type of action was already anticipated going into the last couple of weeks here, where we had a slower move on the upside on the daily time frames, where that channel was already due to get some of these more rapid reversals and corrections, just like we saw on the smaller intraday timeframes for the Phoenix, where the momentum shifted off of the lows. That same thing was happening on the daily time frame in the overall market. So if you guys want to learn a lot more about this strategy, the Avalanche, the Phoenix, as well as all the other ones that I trade, and get into more of that, understanding that pure price development and how all of these factors go into play to create these strategies, I highly suggest you go check out my market timing bootcamp. So I have, a lot of people asking me, how do I understand how all of these things are working together? Well, when you look at the creation of these strategies, you're looking at those building blocks, like the time development, like the momentum, and you're basically putting all of these together. And all of these work not only for developing the strategies, but also helping you understand how to manage the strategies once you're already in the trade. So the bootcamp goes into all of those key building blocks of price development. It goes into the specific strategies that I trade and the makeup of those strategies, how they develop, how they unfold. The same strategies that you guys are seeing me post on Twitter, you're seeing me post every Friday live, you're seeing me post in all of these presentations, and in the live trading room that I did for nearly 15 years every day. So this is a boot camp that basically encapsulates all of my core strategy, my core methodology, and within it, you're going to get 6 weeks of self-paced video bootcamp sessions. So each of these sessions is 2 to 2.5 hours long. So they each focus on one particular aspect of understanding market timing. So first, going through the different key things of price development, the key building blocks, and then it goes into strategy development, and then it goes into trade management. So each of those weeks focuses upon a different core topic. And also, you're going to get a copy of my market timing playbook. So this manuscript is about 250 pages, and it details all the strategies like the Phoenix with the criteria that you look for as it develops, how to manage the positions, pros and cons for the positions, as well as trade examples. So it shows you basically all of my favorite strategies, goes into detail, and it's really something handy that you can keep next to you, can flip through and look at as you're trading. And additionally, the bootcamp includes my 5 technical signals you cannot trade without textbook and worksheets. So this textbook, if you printed that out normally, it'd be well over 400 pages. So it's really in a textbook format. So it goes from very basic core concepts into how to develop those into the more complex ones like you are seeing today. And it also has worksheets where you can apply what you are learning and look at how that compares to, what I ended up doing on the trades and what the outcomes ended up being. So you can go through that at your own pace, and it's basically a really, really great complement to the course itself. This manuscript, the 5 technical signals you cannot trade without. That book is one that I originally wrote about, let's see, it was probably about 12 years ago, maybe 10 to 12 years ago. And what you're going to notice is that everything that's updated since then, it still holds well just as it did back then. So you are getting material that is really, really, truly timeless. So how many of you guys learned a little bit of something today? Yeah, that's awesome. How many of you think that you're going to be able to take away what you learned today and apply it to your trading tomorrow? That is wonderful to hear. Yeah, I mean, like I said, you guys, what's happening in the market right now, if you go back and you look through your charts today, you'll have seen these phoenixes all over the place. Joe asked, do I prefer tick bars in forex? That's a good question. So you've seen on some of my charts that I use tick bars and time frame bars. And the reason I do that is that sometimes I see strategies developing more clearly on a time frame chart, and sometimes I see them more clearly on a tick chart, especially when I'm trading Forex because I'm looking at a lot of after hours data outside of like regular US market hours data. So sometimes you'll see phoenix patterns forming on a tick chart that you might not see forming on a time frame chart just because it's developing and calculating in more of that after hours type of information. So I use both. And I don't weigh one more heavily than the other. I like them both pretty much equally. Sometimes action can be a little bit smoother on tick charts just depending upon the market. So that's where you can get that usefulness for it. And if I'm trading gap trades that are happening in the overall market, like some of those breakaway gaps like you guys saw on Apple, then a lot of times I use tick charts on those right away out of the open just so I can see those swings that are taking place out of the open, because many times those trades are ones that I am taking in those first 5, 10, 15 minutes of the day. So it's really important to be able to see the micro moves that are happening and what that momentum is on the micro level. That it might not matter as much when you're looking at something like a swing trade that you're going to be holding for longer. So do you guys have any questions, any additional questions? I'm going to scroll through this in here and just see what I might be missing from you guys. Do I have a favorite market I trade? No, not at all. I mean, it really just depends upon what's happening in the overall market. You know, when we look at the market and how the market trades over time, certain time frames come in and out of focus. For example, there's going to be like a couple of days in a row where you get a ton of swing trades setting up. And then you're going to be having a period of where the market is moving, and you're not going to have as many swing trades, but you'll be getting decent continuation moves intraday. So that's where it's really great to be able to look at multiple time frames and look at multiple markets. Now, obviously you don't have to trade, you know, those like I do. Some people stick to one market, some people don't. You know, everybody's going to be a little bit different. And, you know, really that's why this is a universal system. I started out as a swing trader. I traded stocks, was mostly holding for several days to several weeks, but at that point, I was constantly following the markets intraday and constantly looking at futures. And this was back before, well, Forex was sort of like the wild, wild west back then. So Forex wasn't really on most people's radar back then. But by simply following the futures every day, I got an incredibly good feel for how the futures market moved. I even got my Series 3, really started to focus a lot more on futures trading so that when it was periods of the market where things were slow in the stocks, I still had things that I could do because I was, you know, focusing on, you know, adding futures. For the last 10 years, Forex has become much more regulated. It's a much easier market to trade. It's more accessible to many more people. You don't have as many like the scams, I guess you could say. It's just a lot safer market now too. So I love trading Forex as well. It's another market. You know, if I don't see a lot in stocks, I don't see a lot in futures, then I'm trading Forex. And it can depend upon what's happening in my life too. I like trading as a profession because I really can adjust it to my lifestyle, you know, and that's something that you guys all have an advantage of doing too. You know, you can make it work for you. Are all of you going to be forex traders? No, probably not, because the hours might not work for you. I mean, there's a lot of times the forex trades are setting up in the middle of the night. So unless you're constantly up or an insomniac like me, forex might not be the best market for you. You know, you might be more geared to trading some of the opening momentum gaps and things like that. So just realize that with strategies like the Phoenix, with the building blocks that I teach in this boot camp, you're going to be able to apply that to all of these markets. So the strategies that you learn in the boot camp that are in the playbook, all of those building blocks, these are things that any time frame you're trading, whether you're using the tick charts, whether you're using the larger time frame charts, it's going to apply to all of them. So with this boot camp, I originally did it live. And so you're going to see a lot of that type of action too. So lots of the live questions, some live market analysis. We did a full day of looking at things where we were looking at live price action too. So I always incorporate current market action, current trades, things that are unfolding. So you guys can understand that we're not dealing with stuff that's like 20/20 hindsight here. We're dealing with things that you can see unfolding right now in the markets where you can take these lessons and go and apply them today. You can go and apply them tomorrow. So go check that out. If you have any questions, you can always reach me at info@tradingfrommainstreet.com. I'll go and throw that email address into the chat box for you guys. So if you have any questions for me, you can reach me there. It's info@tradingfrommainstreet.com. You'll see that in the chat box. And yeah, any other questions you guys have? I know we're running a little short on time here. See, so yeah, I'm just, scrolling through here. So yep, like I said, all markets. Right. So as you go through the course, if you have questions as you go through the course, you can always email me and get a response. So I like to, when I'm responding to questions regarding any of the courses and educational stuff that I do, usually what I do is I will respond using an example from something that might be happening today. So if somebody asks me like, is this something that you would look for on a Phoenix? Then I'll go and pull up a trade that's like my most recent trade on what's happening in the market, or show them something where Phoenix is developing in the market. So like if we look at, let's see what we have, if there's anything that's going on right now. So the dollar yen was starting to attempt one earlier. Up here it did. It actually went. So I made a note that dollar yen was starting to develop at Phoenix before we went into session today. And so you can see what happened. It followed through really well. This is different time zone. I believe we're on Central Time on this one. So you can see that triggered what happened as it unfolded, exactly like you would expect on a Phoenix. So if we go and look at the extension on that, you look at measured moves, you can see that there's that 100% using that last pivot. Let me make this even smaller so you guys can see that even better. So here's that 100% right there. So it was really perfect example. And so this followed through right during our class. So great example. And there's that momentum reversal at the highs, which is another reversal strategy that I use a lot as well. So really good actual one unfolding right now. Let's see. The euro dollar, you'll notice that here's my 120-minute chart. And in the past, I had some fans on here. So you can see that these were holding some of these levels for fans. And what I noticed was that we're coming into support level here. some measured moves. So this is a level that you would often look for things like the Phoenix, but I would want to see momentum start to shift on the smaller time frames. This is really strong downside momentum here. So a lot of times things will slow before you get that Phoenix happening. Sometimes it happens just intraday. Sometimes you'll see it happening on some of these larger time frames. But a lot of times when you see slower reactions off of lows where it might be a really sharp drop into a low, it shifts in there by giving you that Phoenix, and that's what allows it to move all the way back up to those previous highs. So when you see reversals that pivot really quickly like that, it's often because there is a Phoenix or a similar reversal strategy that's happening on that smaller intraday time frame. How low do I see the market going right now? Good question. All right, let's go over and I'll look at the NQ here quick for you guys. So actually, the overall market, what I was looking at heading into the last couple of days was this reaction. A lot of traders are like surprised when you get this strong, sharp bounce off of it. But you have to keep in mind that with large moves like this, you got a lot of automated trading systems that are going off. So when a lot of these hit these certain levels, like 20%, 25% retracements, then a lot of automated trades are automatically buying at these levels. So you can get these really, really sharp reversals as well. That helps with these Phoenix trades also. Now, how far do I think that the market is going to go? Well, when we look at this on the larger time frame, I mentioned earlier I like to think a lot in terms of waves of two, and this isn't going to be the most popular answer, I know, but if I look at this, I'm really looking at one major move on the downside here. So what happens in the past when we get some of these initial major moves on the downside? Well, to a smaller scale, we see that happening in the past here and here and here, and then we get this larger, more drawn out period where it can react, can go more gradually, and then it'll offer a secondary move. Sometimes that secondary move is as strong as the first. Sometimes it's weaker. But usually there is that secondary move. Unfortunately for the bulls here, that's what I'm looking at. So right now, I'm looking for wider channels, bigger swings. That would be more common. Basically, taking the action that you see back here and magnifying it. And that's what is typical at this type of level. Sometimes you will see an initial swing to the lows that manages to make it all the way back up, but that's a lot more rare. It's more common that you're going to see two waves. So basically you're looking for maybe a couple of weeks, couple months of reaction off of this level is possible, but that door is wide open for the possibility of another move on the downside. And what would I look for as a target level for that? Well, basically a little bit lower than what you had here. So I'd probably be looking for right in here as a zone of support for when you're looking at the NQ, for example. So 6,000, 6,100, that level in there is a pretty decent guess for where this could go if this follows through with what happens a lot of times in the past. So that's my target level on this. Let's see here. Any other questions? All right. It looks like Jeanette's reminding me we are at 1:30 here. So I'm going to go ahead and head on out here. But if you guys have any questions about that boot camp, need any assistance getting registered for it, just shoot me on over an email and we will get you signed right up and get you on to continuing your education that you got today. So everyone have a wonderful remainder of your day, and I hope you enjoy the rest of the sessions that I know are planned. And that's it. All right, Jeanette, I'm going to turn it back over to you.